Hi folks, how are you? Hope you're enjoying your weekend. So today's going to be an interesting video. I'm going to mix a few different things together, but generally I'm going to be talking about what I think are the things that come together as being the most important factors in trading for me right now. Now, trading is a journey of personal development, and it's also a journey of fine-tuning and understanding and being able to perceive opportunity on a consistent basis. So right now I'm going to tell you what I think are the three most important things for me right now in my trading journey in relation to perceiving opportunity in the markets. Given the info, because there's a lot of data, right, when it comes to markets and looking at stuff, you can find so much data, but it's important to be able to kind of sift through that data and find the data that is most relevant to your own approach. So for me right now, the three most important points of data right now are going to be, number one, the chart, technical analysis, understanding the structure of the market through the chart, okay? And also constructing trading approaches and trading ideas based on the chart, because that's generally the easiest way to do it. So if you have a nice charting platform, you can use certain key price areas to kind of lean on if you're in a trade. And again, getting back to options trading, because there's a large edge in options trading, depending on the option strategies you trade, you can often lean on certain key price points that you identify through technical analysis. You lean on those prices with your options trades, of course. And the market doesn't necessarily have to go in your favor for you to make a profit because of the nature of certain kinds of option strategies. All right, so the chart is going to be the number one. Number two is going to be the tape, because the tape is the breadth of the market. It gives you info, gives you insight about the market participants, about the secret algos that are kind of positioning themselves in a way where they're not showing the true size they're actually trading. If you learn how to study and read tape, you can identify where the phantom buyers and phantom sellers are positioning themselves. You can identify where those areas of supply and demand are. That's why the tape is important. So on an intraday basis, you want to be able to position yourself based on those price levels on the chart, but also be able to get some extra confirmation from the tape, because like we know, certain analysis you can make on the tape are not possible to make on a chart alone, because a candlestick can only give you so much info. Whereas if you see flow, and you can see transactions coming in, and you can see if those transactions are on the bid or on the offer or in between, now you can start to gather a little bit more information about your market participants and about how much supply there is at a certain area. And that's why the tape is so important. So again, those are the two top things right now. The third one is going to be option pricing. Now this is one that I have yet to explore, is about option theoretical pricing models and the stuff that market makers use to price options. And this right here is going to be the next vein of study in my trading, because I've realized that if I'm going to be a master options trader, I need to in fact understand the pricing models that these market makers are using to make trades and using to manage their risk, using to put on their hedges and all this kind of stuff. A mathematical pricing model is simply something like the Black-Scholes formula, which basically will take into account multiple variables in relationship to a contract, and it will put it into a mathematical formula, and then the formula will spit out a price that should be the theoretical value of an option contract. So I have yet to discover the use of this type of thing in a short-term basis, but I do think that it has a lot of value for an options trader. So if you trade options, you need to know about theoretical pricing models. Therefore, you need to do some math to learn about these pricing models. I'm going to read you through a few things I wrote in my notebook yesterday, just because I was on a bit of a roll. Chart, to identify key price points. Tape, to watch when you reach the key price areas, basically, or new areas. Options pricing model, derived from price outcomes that are possible. Interesting. This is an interesting one that I was reading from the Sheldon Nateberg book, their Options Pricing and Volatility. They're talking about how market makers, they don't like to be short a lot of at-the-money options coming close to expiry, because there's a lot of that gamma risk. Okay, now talking about trading a vertical at the money or slightly out of the money. Now this is more relating to my own strategy right here. So I wrote down a note. I wrote, trading a vertical spread at the money or slightly out of the money, collecting a credit for that trade, with the intention of putting on a hedge if, now this is good, a key price point is clearly breached. Number two, a counter bias trade appears with edge present. All right, did you get that? I'll write it down in the center of the video right here. So this is basically my strategy. Trading a vertical spread generally slightly out of the money or even at the money in certain cases, with the intention of putting on a hedge if a key price point is clearly breached or a counter bias trade appears with edge present. So what that means is that even if I'm in a trade, if I'm in a bias already in a trade, I need to be so clear-minded and objective about the flow and opportunity that I'm perceiving that I need to be able to perceive a counter bias trade, even if it's just a scalp, okay? And when you're able to position yourself in a trade, even if it's a short-term trade, you can find an even shorter-term trade inside of that trade. And that's basically what I'm going after here with this sort of hybrid idea of being able to perceive opportunities inside of opportunities while trading. Now, it might sound confusing. It might not work for everybody, in fact, but it's things that I am trying to understand and incorporate from a perspective of being able to perceive opportunity, okay? When you're trading, you need to be able to perceive opportunity in whatever direction the market is telling. That's it. There's no questions asked about that. You don't go into the market with your own ideas about what you're going to do. You don't go into the market with your own plans about how you're going to make $3,000 today and then pay for your mom's purse. You don't do that. You go in with a neutral perspective because you know that the market is going to tell you what to do. And you need to be open to accepting the truth that it tells you. And sometimes the truth is clouded. There's a lack of clarity. But sometimes there's a lot of clarity. So you need to be ready and show up every day and be ready for that opportunity, okay? That's basically the fundamental point of what I was just saying there, is that taking an options trade slightly at the money or out of the money, but with the intention of putting on a hedge. And again, we'll talk about putting on hedges here real quick. So let's say I entered a bullish position by selling a put spread based on a key price point that I think is a relevant price area, that if that price area breaks, that's going to be my moment where I'm going to put on a hedge, which means I'm going to sell the opposite call spread in the market, or I'm going to cover my short puts altogether, depending on how close to expiry. That's the idea I'm talking about here, okay? I'll just read to you exactly what I wrote in my notebook, note for note last night. Seeing a setup appear in either direction whilst in a bullish or bearish position, identifying edge on either side of a market, theoretical edge versus perceived edge. Now, that goes back to the theoretical pricing models, which I'm in the midst of studying right now. So, understanding a theoretical edge in an option based on a volatility assumption that the market has, that's considered a theoretical edge, okay? Your perceived edge is something that you can perceive by looking at market information like chart and tape, right? So I'll continue going. Probabilities within a larger frame probability are opportunities that should never be neglected, instead used as a means to hedge a current bias if present. Keep an open perspective, a clean slate of perception. That's what's required to trade effectively. Yes, a clean slate of perception. All right, guys, let's look at a few charts here just for fun here. So looking at the Nasdaq, wow, look at this awesome recovery here from the lows. Nobody would have thought this would have happened. Most people were looking bearish. They were looking bearish here. 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 And they're still looking bearish. That's why I think it's totally possible that this market could go to all-time highs, but it can also pull back and go to all-time lows again. So that's what I mean. It doesn't really matter what it does as long as you have an edge present and you can execute your edge on a consistent basis. You know, it doesn't really matter what the market does. So all these people trying to predict whether the market's going to double bottom or double top or whatever you're saying, all of it's irrelevant. And those are the kinds of people, if you follow those people, even if they're right, they're going to continue going forward thinking that they were right the last time. And because they were right the last time about their perceived opportunity about the market going to double bottom, then they're going to keep going forward with that mentality, and that's going to be the death of them eventually, okay? So we don't approach markets from a standpoint of trying to predict what's going to happen. The casino does not know how many people are going to win today, how many people are going to lose today, but they do know where their edge is, and they do know that their edge is being executed on a consistent basis because they have identified their edge. They have a theoretical edge. Cool, guys. So there's the Nasdaq for you. Very beautiful recovery, in fact. I don't really have much else to talk about. You know, we could look at a couple other charts here. Let's just look at the 5-minute chart on Roku. You can see how we gapped down from earnings report. We bottomed around this 124 area. But the point is that we had a bit of a short squeeze first thing in the morning here, which resulted in a massive fade. And look, if people were long the Roku then the gap down certainly trapped them. And that is partly why I was interested in shorting Roku on Friday, is because of that idea where we had the fade and it was likely that we'd see a drastic reversal and break the lows. So I wouldn't actually be surprised if the week coming now we get under these lows and start pushing a little lower for a few percent to trap out some long biased traders that were still in this Roku nonsense. Because, that's just how it is. Markets are psychology. Markets are crowd behavior. Markets are optimism and fear. When too many optimistic come in, they get crushed, unfortunately. When too many people are fearful, that's when the smart ones are trying to buy. So the point of the matter is, because of this 7% move up and down, the most likely scenario was a trading range and not break to a lower low straight away. So I failed to identify the true probability of this market on Friday, which is the reason why I held on to those puts too long and lost more money than I should have. Anyhow, again, getting back to probability is one of the most important things, and perceived opportunity, which relates to obviously probability. What is the probability of success? Now, there's two versions of that. There's what is the probability of success based on the theoretical pricing models that you're using, and number two, what is the probability of success based on the price action and the tape that you're studying? You can assign a probability to a setup. You can say, okay, I think that based on what the tape is telling me and based on the support level, this trade has at least a 60% chance of giving me some profit. All right, guys, I know this stuff is kind of advanced, but take what you can out of it, and I wish you a great weekend. I'll see you tomorrow. Love you. Bye.